Immediately after year-end, we purchased all the stock of Sun Newspapers, Inc. and Blacker Printing Company, Inc., which represents an initial entry into the publishing business, end quote. Ladies and gentlemen, Berkshire Hathaway is on the move. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And we are continuing our ongoing series working through Warren Buffett's annual letters to the shareholders of Berkshire Hathaway. And as a refresher for those of you who may be new to the podcast, the idea behind this series is that we all give lip service to Warren Buffett being one of the greatest investors ever, or I should say a very great investor at a minimum. But so few of us know much about how he actually built his business and what has made him such a great investor. So as we think of ourselves as entrepreneurs, as investors, and otherwise allocators of capital, let's go through and learn from year by year how Warren Buffett built his company from a simple textile company to a multi-billion-dollar, billions and billions of dollar market value, big, massive business conglomerate that Berkshire Hathaway is today. So we started out in 1965, and this week we are in 1968. And I'm going to continue to review a lot of things in this podcast because there's so many core lessons that we're going through each week that I want to make sure we don't miss out on what's been said before as we build on it for the future and each week with each new episode. So there's going to be review. So I'm going to give everyone permission to allow yourselves to hear review and to have some repetition, because that repetition is what's going to help shape our minds and our thinking as entrepreneurs and investors. So the idea that we're pursuing this podcast is building our own personal Berkshire Hathaways. And so again, Berkshire Hathaway is Warren Buffett's company. And I want us to have the mindset of viewing our household as a business, okay? And so my household is a business, and so with my household, I want to be building my own personal Berkshire Hathaway, building my household into a very successful business in itself. And so that starts all the way on the bottom foundations with having sound budgeting and getting your household in order financially, controlling expenses, and insurance and emergency savings accounts and emergency funds and all that kind of stuff, having liquidity, all those core aspects. And then once those things are in place, seeing what excess capital is available to then allocate that capital in a way that you get the best possible return on investment that you can. That could be investing in training to advance your career. That could be investing in some kind of resources or training that can help you build a side business. It could mean buying a rental property. It could mean allocating that capital toward the public stock markets, or it could mean buying an interest in a private company. There's all kinds of things it can mean, but that's the mindset I want us to have, and that's shaping this series. So all that being said, let's jump into the 1968 letter to shareholders written by Warren Buffett to the shareholders of Berkshire Hathaway. So again, they continue to have the core of the company continues to be the textile operations, but as we've seen, more and more the company is being diversified into other sectors, but we still start out with textiles. And early on in the letter, Buffett talks about the fact that while there's been some improvements in different areas, the stockholders' investment or their operating earnings in relation to stockholders' investments are still not satisfactory. One takeaway I want to bring from that is the fact that he's really not satisfied with how, especially the textile portion of the operations are performing. But he hasn't been satisfied for a couple of years, and he hasn't just jettisoned that operations. He didn't just sell it as soon as it had a bad year or a bad quarter. Lesson learned, it's important to be patient with our investment thesis. So whatever a thesis in any given investment we have to ask ourselves, are we giving that thesis enough time to play out? And that may mean longer than we want it to be. It may be painful in the interim. But unless that thesis changes, then we have to ask ourselves, is there any good reason to get rid of the investment in the meantime? And so we see with Buffett, they've been making lots of changes in the textile operations. They have gotten rid of some portions of those operations. They have ramped up some other portions of that operations. And so again, the mindset of patience and doing market research and understanding the company or investment that we have and what we should do with it, how we should view it. All that being said, there's 1.1 division of the textile operations that has had severe operating problems. And as a result of careful survey of the future market, they have decided to phase out that operation during 1969. And so this is 68. Or actually the letter was written in 69. So basically in 69, they want to start phasing out that operation. So again, they didn't jump to conclusions. They did careful survey of the market, the future market, trying to figure out of what is the future really potential of this operation and of this sector. And is there reason to continue to allocate capital in this direction, not knowing, or if we're not confident of the future potential? And based upon that careful survey and research, they decided to close or phase out that operation. So again, is that our mindset when we have a stock in our portfolio or any kind of, if we have capital allocated in an investment, are we before we get super upset because it's not doing what we want it to do, it's not jumping in price or performing as quickly, are we performing proper research to decide whether or not the thesis has changed and whether or not we should remove our capital from that investment? That's been the big takeaway there. Another really interesting thing that Buffett said actually before this regarding the textiles is he said they do have a line in the textile operations that has been doing well. And it said that they talk about opportunities for potential expansion in that line of product. And then he says, we hold options on additional looms, again, looms in the textile industry, enabling expansion if profitable projections materialize. I love that idea of him holding options. And again, you think of options, a lot of us will understand options in the equity world in terms of basically you're buying the option to do something in the future, to either buy something in the future or sell something in the future. And again, that idea can exist outside of the public markets. You can buy options really on anything you want as long as you can find someone to sell it to you or to buy it from you. You can sell an option if someone wants to buy it, or you can buy an option if you can find someone to sell it. That's actually a lesson you can learn from the movie or the book, The Big Short, which has had a lot of influence on me. And the idea was, one of the major characters from the movie The Big Short, he saw the problem in the mortgage industry and the mortgage-backed securities, and he realized these things are going to bust. And so he wanted to find a way to short, basically, the mortgage industry in a sense. I'm simplifying the idea. But there was no tool, there's no means through which to do that. And so, of course, he had the assets to do so, and he went to a lot of these major banks in New York, and they said, hey, I want you to create an instrument that I can buy, or so I can short it or buy it, so I can bet against the mortgage industry. And they all thought he was ridiculous for doing so. And they say, we'll gladly create this product to make money off your ridiculous idea. The lesson learned from that for us, in my opinion, is if we have an idea or we see an opportunity, and again, if we do our due diligence, if we are very wise in what we're doing, we seek proper counsel, don't do anything haphazardly or what do I want to say? Without using discretion, essentially, then perhaps there's an opportunity in your local community or otherwise, or in your business industry or something like that where you could create an instrument. And the instrument gets created when you have a buyer and a seller. And whichever end you want to be, the buyer or the seller, are there areas that you might want to buy or sell an option on a local business, for example? Maybe you see great prospects, or in this case, Warren Buffett, they thought, we might want to buy additional looms. And so let's have options to be able to do that in the future at a price and a means that we want to be able to do that on. So I thought that was a fascinating idea to think of using options outside of the public markets. Just again, one more way to kind of diversify our thinking of things we can do in terms of allocating capital and in creating income streams or income capital inflow streams of capital into our businesses, aka our personal households. So just kind of some cool, neat ideas to consider there. So I'm going to leave the textile operations and jump over into the insurance operations of the company. And this has kind of been a couple years ago in relation to Berkshire Hathaway, that is. We're in 1968 of this letter. And in previous letters, he talks about how they purchased an insurance company and how he's just you gotta tell he's kind of in love with this insurance company. He's thrilled with how it's performing. It's doing fantastic. He always likes to bring up how splendid the operating performance is under the manager, Jack Ringwalt. And a thing I like to bring out there is the fact that he is quick to praise his managers. Having quality management is a really big deal for Warren Buffett. It makes me think about in the startup world or the venture capital, the private equity world, specifically venture capital, you'll hear so many times when venture capitalists are looking to make investments in a company, oftentimes the core things they look to invest in is the founder and the founder individually or the founding team, because they say if we believe in that person or that team of people, their current idea may not be any good, it may not materialize, but they're confident that that team will produce something valuable in the future, so they'll make that investment there. Obviously, that's a little more risky than Warren Buffett would do, but he has a similar idea in terms of how highly he values the management team. And so obviously he wants to make sure there's a really solid business around it in existence. He's not hoping in the future. But that's, again, a mindset that I think I want us to have as well in terms of valuing management extremely, very, very highly. Because if we have solid management, then we can trust our capital or our assets much more willingly to that management by investing in their company. Because again, you think about all the work that you and I are doing to become better investors, to become better entrepreneurs and allocators of capital, business builders, and all that kind of stuff. You'll think about how fantastic would it be to surround ourselves with other like-minded people. And we can do that through our investments, by making investments in other businesses that have like-minded management to ourselves. Then we're diversifying ourselves with other like-minded people, hopefully even smarter and more gifted and talented than we are. Again, more things to use to shape our mindset as investors. Another thing I want to bring out of Warren Buffett's discussion of his insurance operations is remembering we started this back in 1965, the 1965 letter, and we've gone through several years now. We're in 1968, and I believe it was last year, which would have been 1967. In the 1967, I believe that is the first year they announced the purchase of their insurance subsidiaries. So here, he purchases Berkshire Hathaway in 65, then you have 66, 67, and now we're in 68. So it took about 2 years for him to make the investment to purchase that his insurance operations, which are performing splendidly. So again, the mindset. So many of us have the mindset that if we have cash, we have to invest it because we want to make sure, we're not losing out to inflation, or the idea, quote unquote, cash is trash, which I think is a ridiculous idea. And we think we have to allocate that cash quickly in our portfolios to buy companies to make sure we're getting a return. But the thing is, you can lose money just as quickly and easily as you can make money in the stock market. So why be in a hurry to deploy that capital, haphazardly? And so again, I want to reinforce the idea that, and we'll get into some broader investment ideas in the next section of the letter here in a moment. But right now, I'm focusing on the more core investment ideas, because in a moment we'll talk about how Buffett and Berkshire were investing their capital in the public markets and marketable securities, because they didn't have a major acquisition that they were excited about, so they wanted to be making money on that money somehow. And so that's a cool idea, but I'll talk about that more in a moment. But the more crucial things are the acquisitions, like in this case, the insurance company. So when they make a major acquisition like that, that's a major piece of their portfolio. I've mentioned in previous weeks the fact that in 50 years, Berkshire Hathaway purchased 59 companies. Think about that. Think about at your current rate of churn in your portfolio, how many businesses or companies do you expect to buy and sell in 50 years? I guarantee you it's probably a lot more than 59. Some of us that's probably happened maybe in just a couple of years. So again, but Warren Buffett, with all of his success in Berkshire Hathaway, it took a couple of years before they bought their first company. So again, what if we had the mindset that we want to make one great investment each year that could reward us for years to come? One of the ideas we've talked about before is a book called 100 Baggers, which again has a really kind of almost like a spammy title, but in reality, it's talking about investments are companies that have returned or increased in value by 100 times over a period of time. It could be a very short period of time, but in most cases, it took decades for these companies to get a 100x return on the initial investment. And a lot of those companies end up being really boring companies like Colgate and things like that. And so the idea is if you invest $10,000 in one investment that increases 100-fold, you have $1 million. So if you have just a handful of investments like that in your lifetime, then almost every other investment you make could torpedo and do terribly, go to zero even, and it almost doesn't matter because you had a handful of investments that performed marvelously. And so the idea is, what if we try to make one fantastic investment per year, right? And then, or two even. And then we do that year after year after year. After 20 years, you've got 20 to 40 fantastic investments. And in reality, of those 20 to 40 fantastic investments, only 3 to 5 need to really materialize in a really fantastic way like we've discussed. And again, that's still no simple, small feat, but it's much more accessible than I think many of us think. The problem is we don't think long-term enough. And if we think the idea of not worrying about anything but finding one great investment per year, maybe in the scope, in the process of researching and doing the due diligence to find that investment, perhaps we find other great investments, and maybe we make more than one investment per year. Certainly, if you look at the history of Berkshire Hathaway, there are several years they've made more than one acquisition. But the thing is, they waited for the right opportunities, and that's the mindset I want us to have as well. And that's going to come into play in the next section of the 1968 letter when Buffett talks about marketable securities and acquisitions. And he talks about how they had $1.5 million because they sold some of their marketable securities and had a profit of about $1.5 million after tax. And so Buffett talks about the reason for those, basically the capital that they've allocated the marketable securities has been purely just like a holding place. Like, we have this money, we don't have an investment we're super excited about yet, so we're going to put it in something. He doesn't get into the detail of what those securities were, but I assume it was a basket of securities where they can make some money while waiting for an acquisition opportunity. And they did that. And they made $1.5 million on the portion that they sold in 68. Then at the end of 68, they had unrealized market appreciation of $6.4 million in that portfolio. And they said such securities were held in marketable common stocks as a temporary investment, pending the utilization of the funds in acquisition or expansion of operating businesses consistent with our program for the development of greater and more diversified earning power. They continue to have the mindset of they want to allocate capital in the area where we can have the greatest and most diversified earnings power possible. And so again, I want us to have the mindset of Berkshire Hathaway was a textile company, but they are significantly already diversifying beyond that. And over time, the textile companies are going to fall more and more into the shadow of the other companies. And again, in our household, maybe right now we think, okay, my income from my job is my primary means of capital income, my primary means of inflow of cash and appreciation and things like that, or of gaining capital, I guess I should say. But what if that changes in a few years? I'm sure back in the early 60s, Berkshire Hathaway never thought of being anything but a textile company. And right now you may be thinking of yourself as being nothing but the career that you're in and that always being your primary means of income. But what if that can change in a few years? What if over years you can begin to build a side business or a side income stream to either supplement your current job or eventually replace it? Those are all possibilities. And I'm not saying, make your own decisions, use good judgment, but at least have an open mind to the fact that those things could be true. And because again, that's kind of part of the mindset that Berkshire Hathaway has is, we're looking for what can give us the greatest return on our investment, our capital. And I think it's smart of us to think of our time as capital as well. How can we best spend our time? Is it in our current job or in something else? And also an idea here too is that if you have cash that you feel like you're just dying to do something with it, you can't hold it in your portfolio or in your bank or whatever else, instead of going in and just haphazardly deploying it into the stock market or somewhere else, one thing that we can possibly consider is putting that money in, again, a quote unquote basket of securities, or maybe put it in an ETF like SPY or some very conservative ETFs where maybe it can be getting a little bit of a return over time while we're waiting for a quote unquote acquisition opportunity. Because every company we buy stock in the public markets, I want us to view that as an acquisition opportunity. And I want to view it with that same level of seriousness. And if we have not done the due diligence that we would do on an acquisition opportunity, then we should not be buying the stock either. And I know that sounds kind of extreme and strict, but I think this is a big deal. Deploying our capital is a big deal. And if we view it as anything but a big deal, then it's probably going to come back and bite us. So if you feel like you need to invest money, think about putting it in a conservative ETF. And then potentially when the moment is right, when the right opportunity presents itself, then you can consider making an acquisition with that capital. So that being said, we move on, and where Buffett discusses, it says, immediately after year end, we purchased all of the stock of Sun Newspapers Inc. and Blacker Printing Company Inc., which represents an initial entry into the publishing business. It says this purchase involved only a small portion of our funds available for acquisition. Sun Newspapers Inc. publishes 5 weekly newspapers in the Omaha, Nebraska area with paid circulation of about 50,000. A related printing business is conducted by Blacker Printing Company, Inc. This purchase, while small, has potential for future expansion. The operations will continue under the able management of Stanford Lipsey, again, highlighting the importance of management. And it's nothing else. Buffett, they're going around, they're finding great management and solid businesses with great opportunity. Sorry, I'm talking too fast. And they're purchasing them and keeping that management in place. And so they're not expanding their current oversight that much because they trust the current management. And when you can trust the management of your acquisition, it dramatically reduces your stress levels and dramatically reduces the amount of energy you have to devote to overseeing that acquisition, that asset. That's a really big deal that I don't want any of us to miss. Another really cool idea with this is, he said this was a really small portion of their funds available for acquisition. It's really, within the scope of Berkshire Hathaway, it's a small company, a very local company there in Omaha, Nebraska, but it's one that has the potential for great expansion and has great management. And so again, I can't help but think about our local communities. What are great opportunities in our local communities or your local communities where maybe there is a small business that maybe you could purchase a minority stake in, or maybe you could purchase outright. Or maybe you know someone that wants to start a business, you could help become a founder, a capital someone who allocates capital toward that business. Again, these are all things you should think of very carefully and not do flippantly. But I want to. These are the ways that I want to be thinking, and I want all of us to be thinking, because these are the ways that master investors, the expert allocators of capital, think. This is the way that Warren Buffett thinks, and so therefore I want us also to have similar type mindsets in our businesses. So those are a lot of the key takeaways in my mind from the 1968 Berkshire Hathaway letter. And thank you so much for all the emails I've been getting from you. It's been so fun to hear from you. So many of you who are also excited about this series, just like I am. If you want to talk to me, you can always email me at Brian, that's BRIAN, at investorinthefamily.com. That's Brian at investorinthefamily.com. Or if it's easier, mail at investorinthefamily.com, MAIL at investorinthefamily.com. I cannot wait to hear from you. I love getting your emails and getting to know you better. So everyone have a great week. And side note, I might not have a podcast next week due to some being out of the office for a little bit, but we'll kind of keep you in suspense. So maybe I'll be able to record one and put it out. But if you don't get one next week, know that I'm still alive and the series is going strong and well. But in the meantime, have a fantastic week, and I can't wait to hear from you. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.